Every single business, from the tiniest coffee cart to a massive factory, needs tools to get the job done. But have you ever really thought about what those tools, like a company car, a computer, or even the building itself, actually are on the books? And maybe more importantly, how their value changes over time? Well, that's exactly what we're going to break down today: the whole world of property, plant, and equipment. Okay, to make this super simple, let's start a business together, right here, right now. No complicated spreadsheets, no corporate jargon. We're opening a good old-fashioned lemonade shop. It's honestly the perfect way to understand the physical stuff that makes any company tick. So for our brand new lemonade empire, we're going to need some gear, right? A table, a juicer, some glasses, maybe a little stall to work from. Now, notice what these things are. We're not talking about the lemons or the sugar, the stuff we actually sell. These are the durable tools we're going to use over and over and over again. So here's the thing. In the world of accounting, these physical items, our cool juicer, our trusty table, they aren't just called stuff. They've got a formal name that lumps them all together. So let's find out what it is. It's called property, plant, and equipment, or what you'll usually hear is just PPE. And the key idea here is this. PPE are the long-term physical things you use to run the business, not the things you're trying to sell. You use the juicer to make the lemonade. You don't sell the juicer itself. That's the big difference. And this concept, it scales up to literally any business you can think of. A taxi company? Their cars are equipment. A software startup? Their computers and servers are equipment. And for a giant manufacturer, the entire factory can be considered plant. It's all just PPE on a totally different scale. Okay, so you did it. You bought a brand new, top-of-the-line juice machine for our shop. Awesome. But now, how much do we say it's worth in our company's records? It's actually a little more complicated than just looking at the price tag. This is where it gets really interesting. The true cost of that machine isn't just its sticker price. You have to include everything it took to get that machine up and running. That means you add the cost of shipping, you add what you paid someone to install it, and you even add the cost of running a few tests to make sure it works right. And just look at how this all adds up. That machine we bought for $10,000, once you tack on delivery, installation, and testing, is actually recorded on our books as an asset worth $11,500. That's its official starting value. And believe me, that number is going to be super important for what comes next. All right, let's just pause for a second and switch gears. I want you to picture a brand new bicycle. It's shiny, it's perfect, you ride it everywhere. But what does that bike look like after a couple years of adventures, of being left out in the rain? Well, it's the same journey every asset takes. In year 1, it's amazing. But by year 5, yeah, it's seen better days. The paint's faded, some parts are getting worn out, and its value? It's definitely not what it used to be. This natural process of losing value, of getting worn out over time, it has a name in the business world, and it's one of the most fundamental ideas in accounting. It's called depreciation. You can think of it as the financial story of an asset getting older. To put it as simply as possible, depreciation is just the organized way a business recognizes that its tools don't last forever. It's the process of accounting for that drop in value as an asset gets used up. So why does this even happen? Well, it's usually for a few key reasons. First, there's the obvious wear and tear, just from using something every day, like our bike. Then there's technology making things obsolete, like that 5-year-old laptop. And sometimes things just lose value because, well, time has passed. So if we know things are losing value, how do businesses figure out by how much? I mean, they can't just guess, right? There are specific formulas for this, and we're going to look at 2 of the most common and simplest ways to do it. I love this analogy. It's perfect. For our first method, the straight line method, just picture a chocolate bar. If you eat 1 square every single day, the bar disappears at a perfectly steady, even pace. This method assumes an asset loses value the exact same way, the same amount year after year. And if we were to chart it, this is exactly what it looks like. See how the bar for each year is the same height? The value lost, the depreciation, is identical every single year. It's a straight, predictable line. This works great for things like buildings that tend to lose value very slowly and evenly. Okay, but we all know not everything ages that gracefully. Some things lose a ton of their value right at the beginning. And the absolute best example of this is a brand new car. Come on, you've heard this a million times, right? A new car loses a chunk of its value the second you drive it off the lot. Well, there's an accounting method designed for exactly that. It's called the declining balance method, and it records more depreciation in the early years and less as the asset gets older. Now take a look at this chart. It's a totally different story, isn't it? That bar for year one is huge. That represents that massive drop in value right at the start. Then it starts to level off in the later years. This is way more realistic for things like vehicles or new tech. Okay, so we've covered what PPE is, how to figure out its cost, and a couple of ways it depreciates. You might be thinking, all right, but why does this actually matter? Well, this is the big picture. This is the so what behind all of it. Look, at the end of the day, tracking this stuff gives you a true, honest picture of how your business is doing. It helps you figure out your real profit because it accounts for the cost of using up your tools. It lets you plan for the future so you know when you'll need to replace old gear. And here's the big one. It's a legitimate expense that can actually lower your tax bill. And so I'll just leave you with this final thought to chew on. If a business brings in $1 million in revenue, but in the process it completely wears out $1 million worth of its machinery, did it actually make a profit? Understanding all this, it's not just boring accounting. It's about understanding what makes a business truly successful in the long run.